The 10 questions people actually ask about asset protection and the honest answers. I get the same 10 questions about asset protection, almost word for word, almost in the same order. I'm going to answer all 10, and I'll tell you up front, 4 of these answers you're going to be disappointed by, because the honest answer is not the one being sold. Hi, my name is Joseph Jones III, and I'm the founder and managing director of Universal Capital Alliance Group. I'm not a lawyer, and I don't sell trust. I teach people what these structures actually do so they can sit down with licensed professionals and know what they're looking at. Let's go. Question number 1. Can they take my house? This is almost always the first question, and it's the one with the best news in it. Every state exempts some amount of home equity from creditors. The catch is that the amount varies enormously. A handful of states, Texas and Florida among them, protect an unlimited or nearly unlimited amount of equity in a primary residence, subject to acreage limits and other conditions. Other states protect a few $1,000s. Some protect almost nothing. Before you spend $1 on any structure, find out what your state already gives you for free. Homestead exemptions, retirement account protections, life insurance cash value, annuities, wage garnishment limits. In some states, those exemptions cover most of what a middle-class income family owns. I've watched people pay for elaborate planning to protect assets that were already exempt under state law. Start with the free protection, then decide what's left over that needs attention. Question 2. Will an LLC protect me? Partly. And people badly misunderstand which direction it works in. An LLC protects your personal assets from liabilities that arise inside the business. Someone slips in your store. The claim is generally against the company, not your house. What most people miss is the other direction. If someone gets a judgment against you personally, a car accident, a personal guarantor, that creditor may be able to reach your interest in the LLC. In many states, the primary remedy is a charging order, which gives the creditor the right to distributions if any are made, but not the right to take over the company. That's meaningful protection. It's also not absolute, and it varies significantly by state. The single-member LLCs get treated differently from multi-member LLCs in a number of jurisdictions. And none of it survives if you don't run the company like a company. Commingled funds, no records, no separate accounts, personal expense through the business. That's how veil piercing happens, and it's the most common failure I see. The entity doesn't protect you. Operating the entity properly protects you. Question 3. Do I need to go offshore? Most people don't. Offshore structures are expensive to establish and expensive to maintain every year permanently. They carry annual federal reporting obligations with serious penalties for getting them wrong. And they require you to genuinely hand assets to a trustee you don't control. For most people, the sequence that makes sense is state exemptions first, then proper entity structure and operations, then adequate liability insurance, then domestic planning options, and only then, if your exposure and the asset base justify it, an international structure. Below roughly $1 million in liquid assets, the annual cost of an offshore structure consumes an irrational share of what you're protecting. I say that as someone that could be selling you the opposite. Question 4. Will this lower my taxes? No. And I want to be clear about this as I know how to be. A foreign trust set up by a U.S. person for U.S. beneficiaries is generally treated as a grantor trust. The income is taxed to you on your return at your rates, exactly as if the trust didn't exist. There is no deferral, there is no reduction. What you add is reporting. Form 3520, Form 3520A, FinCEN Form 114 if there are foreign accounts, possibly Form 8938. The penalties for late or missing filings are substantial, and they're assessed per form per year. Domestic asset protection structures are generally tax neutral as well. They're not tax planning. If anyone tells you an asset protection structure will reduce your taxes, stop the meeting. They're either uninformed or they're selling something you shouldn't buy. This isn't a closed question, and the offshore industry's own published material says the same thing. Question number 5. I'm already being sued. Can I still do this? No. And this is the question where the wrong answer does the most damage. Every state has a fraudulent transfer statute. Most have adopted versions of the Uniform Voidable Transactions Act. Transfers made with intent to hinder, delay, or defraud a creditor can be unwound. Courts look at a set of established indicators: whether the transfer happened after a claim arose, whether it was to an insider, whether you kept control, whether you got fair value, whether it left you insolvent. Moving assets after you've been sued hits nearly every one of these. And here's the part that's genuinely serious. A U.S. court doesn't have to reach the assets. It can reach you. A judge can order you to bring money back, and if you don't, you can be held in civil contempt and jailed until you comply. Civil contempt has no fixed term. It runs until you comply. There are people who have spent years in custody over exactly this. I'll say this plainly. If you're facing a lawsuit, a judgment, or a demand letter, you need a litigator today. Not a planner, not me. Anything built for you right now becomes evidence against you later. The single best thing you can do is get competent defense counsel and negotiate. Question 6. How much control do I keep? Less than you want. And this is where most structures actually fail. Courts examining asset protection structures look for retained control. When a settlor keeps a practical ability to direct the trustee through the power to remove and replace trustees, through protection powers, through informal influence, courts have treated compliance with a repatriation order as being within the person's power and imposed contempt when they refused. The relationship is inverse. The more control you keep, the less protection you have. You cannot maximize both. So the real question isn't how much control do I keep? It's, are you actually willing to give assets to someone who might tell you no? Most people, when they understand that clearly, decide they aren't. That's a legitimate answer, but it means these structures aren't for you. And it's far better to reach that conclusion before you spent $30,000. Question number 7. Is this legal? Prospective planning is legal. That word is doing all the work. Structuring your affairs before a claim exists is what every estate planner, every business lawyer, and every insurance professional does. It's ordinary and it's lawful. Moving assets to defeat a creditor who already has a claim is a different act with a different name. And the fact that it's accomplished with a legal document doesn't change what it is. The line is timing and intent. Before a problem exists, you're planning. After a problem exists, you're transferring. And courts have decades of experience recognizing the difference. The structures aren't legal or illegal. What you do with them and when is what determines that. Question 8. Is any of this private? Less than it used to be and getting less so every year. Beneficial ownership reporting requirements have moved repeatedly in recent years, in both directions. And I'm not going to state the current rule from memory. Check it with your professionals as of today. But the direction of travel over the last decade is unmistakable. Internationally, financial account information is shared between jurisdictions under the Foreign Account Tax Compliance Act and the Common Reporting Standard. Offshore accounts are reported to tax authorities. In Nevis, the registered agent is required by statute to maintain current information of the settlor, trustee, protectors, and beneficiaries of an international trust. The era of financial secrecy is essentially over. What these structures offer now is legal protection and procedural obstacles, not invisibility. Anyone selling you privacy or secrecy in 2026 is selling something that no longer exists. Question number 9. What does this cost? More than the quote, and forever. Domestic entity work is generally modest. Domestic asset protection trusts run higher. International structures are substantially more to establish, and this is the part people forget, carry recurring annual costs for trustee fees, government fees, and compliance that continue every year you have the structure. I'm not going to give you specific figures because they vary by provider and they change. Ask for the total first-year costs and the recurring annual costs, in writing, all in. Then add the costs nobody quotes. Your own accountant's time on the additional filings every year, your own attorney's review, and the real one, the assets you've given up control over. If the annual cost is a meaningful percentage of what you're protecting, the structure is a wrong answer to the problem. Question 10. What actually works? Here's the honest hierarchy. Cheapest and most effective first. Insurance. Adequate liability coverage, umbrella coverage, and professional coverage. It's the least glamorous answer, and it's the correct first answer for almost everyone. Insurance pays claims. Structures only make claims harder to collect. Nobody sells seminars about umbrella policies because there's no money in it. State exemptions. Free, automatic, and frequently substantial. Know yours. Proper entity structure, properly operated. Separate accounts, real records, actual formalities. Then, if the exposure genuinely justifies it, trust structures. Established before any problem exists, with genuine relinquishment of control, with full reporting through licensed professionals. And the thing that outperforms all of it, not creating the liability in the first place. Good contracts, good documentation, competent professional practices, sound counterparties. The single most important variable in this entire field isn't the jurisdiction or the trustees or the drafting. It's timing. Everything works when you do it early. Almost nothing works when you do it late. Those are the 10. 4 of them had answers you didn't want. No tax benefit, no privacy, no help once you've been sued, and less control than you'd like. I'd rather you hear it from me than find it out from a judge. If you want to go deeper, we published a written briefing that documents every one of these points with the statutes and the court decisions behind them, so you can verify them for yourself rather than taking my word for it. That's the point. Read the sources. And if you're currently facing a claim, close this and call a litigator today. Universal Capital Alliance Group. Verified information first, everything else follows.